Is Module 10. We are going to talk about different theories of market efficiency and some different trading information and a bunch of other stuff. The PowerPoint for this, this is a slide that I added. So there's a bunch of different kinds of market efficiency, and well, three. And they are weak form market efficiency, semi-strong market efficiency, and strong form market efficiency. The point of these is to sort of give different theories of how information is incorporated into prices for stocks. This theory itself was created, I want to say, about 50 years ago, and has become sort of the common way that people talk about the market. So weak form market efficiency is all we have are prices, that everybody can see the prices, everybody has some computer that can look at past prices, and therefore the current price incorporates all of those past prices, and that's all we have. Semi-strong says all public information is reflected in prices. So anything that's on the news, in theory, anything that you could see if you like walked past the store or whatever is public information. It's like apples on a tree. You can go up and pick them and they're yours, and therefore the price should incorporate all of that information because everyone has access to those things. The last thing is strong form market efficiency, which is all information, public and private, is reflected in prices. And let me skip down a little bit. I should have ordered this slightly better. Yeah, never mind. I'm not going to do that. Let's talk about bubbles. So once you have all of this information about weak form efficiency and whatnot, then the next question is, well, what's a bubble? If all information is included in prices, then what does it mean when we have a bubble? Well, a bubble would be a substantial volume of increase in trade. You would switch from institutional investors, which would be like pensions and hedge funds and mutual funds, to retail investors, which would be like guys sitting in their underwear trading in their house while they're eating Doritos kind of thing. And usually what happens is you'll hear about people making trades and how great the stock is. Like, for instance, every now and then I get somebody on my Facebook page who wants to talk about investing, and you can tell kind of how frenzied a bubble is going on for different stocks because different people will respond that have no business talking about investing. Trades made without consideration of fundamentals. So a lot of times people buy something and the idea is it's just going to continue to go up. A good example of that would be the South Seas bubble was one of the first ones, but tulip mania is one of the more famous ones. It was in Holland, I believe, in like the 1700s, and tulips became very, very expensive. So you could buy tulips for the same price that you would spend on a house because they were rare and hard to come by. And eventually the bottom of that market fell out. People stopped buying them, and people lost a lot of money. This is just kind of my own interesting thing. This is a Google Trends for the word bubble, and you can see that it kind of reaches a crescendo in 2008 and then slowly like goes back down, and you don't really see it anymore. Maybe they're calling it something different, but no one really thinks about bubble recently. So there's some really interesting books about different types of behavior. I'm going to show you a few of these just so you have them. These are books that by no means you need to read for this course, but are super interesting just in and of their own right, and are things that if you knew about and you could talk about on your interview or whatever, that people would be impressed. Not everybody reads them. I've read personally all of these, and that's why I'm recommending them, because they are awesome books. So the first one is by Richard Thaler. It's called Misbehaving. Anything that Richard Thaler has written is awesome. He won a Nobel Prize for this research, and essentially what he says is we have this theory that investors are completely rational, and he identifies ways in which they are irrational. So if you look at this PowerPoint, a lot of these are mentioned in his book. So one is overconfidence. If you trade frequently, you do less well. Women tend to do better than men for that reason, because men are super confident and they trade a lot, and women just sort of trade once and let it sit, and that actually does better in general. investors don't like to sell stuff that's losing money, so they tend to hold on to losers too long. There's a home bias, so you tend to invest in things that you know about and that you think are near and close to you. So, for instance, Lululemon is a big one. Every time a Lululemon opens up in some area, everybody wants to invest in it. And then finally, like personal information that you've recently observed. So it's like a recency bias. If we had the pandemic today, or we're dealing with it now, we are going to overweight the probability of that happening in the future, even though pandemics only happen every 100 years or so. Well, at least this one did. So there's a tension because we know that these biases do exist, but we're not sure exactly what that means for the market. Our models do reasonably well, but not perfectly well in predicting behavior and trades and things like that. And so the question is, like, how much are we willing to put up with in terms of inefficiency in our models in order to not have to deal with all of these different biases that make people trade in weird ways? There is pretty clear evidence that weak form efficiency exists, and yeah, that's all I want to say there. Strong form efficiency is not something that we have evidence for. We're kind of probably somewhere in the middle between those two. There is insider trading. You guys saw that in the stock market recently with the senators who sold all their stock before the big announcement that there was a pandemic. Those things happen, but it's not clear that everyone operates on inside information. And so that leaves semi-strong market efficiency, which is probably the one that is most likely in our information. There is some evidence that that supports that it exists, and there's other stuff like these anomalies where people trade on, minute things that they never thought would happen kind of deal, and that happens reasonably often. But it's hard to make a lot of money on that in the long term. I'm going to let you guys read through this. There are a lot of different sort of pros or cons. And you can look at security selection. One thing that you should note is that information is costly. It costs a lot of money to collect information. Like, you think that it would be easy because you could just log into Edgar or whatever and download information about a company that's public. But the truth is that everybody has that information. So for you to have it doesn't really help that much. There are hundreds of firms that specialize in creating information for hedge funds. One of those that I actually talked in class, where Howard Shillett used financials to talk about accounting fraud or even just improper accounting, and he would sell that to hedge funds as a way for them to get additional information about the companies they were talking about. The other thing is, even if you know that some of these anomalies exist, it's very hard to actually find a market where you can do that. And so even though you may know of it, there may not be a way to capitalize on it. And finally, like, there's a lot of cost to making these trades. So you may not have access to capital, and it may be difficult for you to access those markets or to trade at a low enough cost. And the last thing, these are interesting and you should sort of think about those things, but let me show you a few more books. Thinking Fast and Slow is Daniel Kahneman. It is a 500-ish page book, but it's a really good book. Daniel Kahneman won a Nobel Prize, and he worked with Daniel Tversky, who's also a Nobel Prize winner. They won it together. I don't think they won it together. I think Daniel Tversky passed. But anyway, Thinking Fast and Slow is about your innate sort of processing system and how people use numbers in ways that are weird because of this innate processing that we do of information. It is a fascinating book. It's a long read, so if you like audiobooks, that's the way to go. The other thing is Predictably Irrational. Dan Ariely has a lot of, let me just look him up so you can see. He has a Twitter page, and he has a ton of YouTube videos. Are we in control of our decisions, our buggy moral code? There are all kinds of interesting things. And it's basically about how people are not rational and how business school professors have worked really hard to figure out what irrationality is and how to quantify it and what the implications are for consumers and decision making. So if you are interested at all in that sort of thing, I highly recommend this book. And the last one is Burton Malkiel's A Random Walk Down Wall Street. And his point in this book is that you can't predict what's going to happen to stocks. Since we believe that markets are efficient, that we're probably in some middle ground of efficiency, that if everybody knows this information, then there's no reason to think that the price that you're getting for a stock is better than the others. And therefore, the only way that you can really make money is to just buy an index of stocks because you're betting on the entire market to go up. Like your price today that you get for the stock is fair, but there are things that improve over time because the market improves and innovations happen and people get better at it. And so this idea sparked what's called the index fund revolution and passive investing. So passive investing is where you buy an index, meaning you buy stocks in the percent in which they are in that index, and you just hold it. So there's no bet on a particular company or a particular industry. It's just S&P 500, Dow, whatever you want to buy, and you just hold it because you don't think that you can do better by buying any particular stocks. And there's a whole bunch of people who argue one way or the other about why these things are right or not right. The message that I want you to get out of this is just that Burton Malkiel wrote an interesting book. If you want to go work at a hedge fund, you should read it just so you know what it's like. But in general, the theory of this is that markets are efficient, and therefore there's no additional gain that you can make by collecting information. You should just invest in the index. So that is module 10. It's a short module. I hope that was helpful. Market efficiency, what is a bubble, and then just general irrationality. I hope that helps.